Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lanka's plan to remove para-tariffs is expected to significantly reduce import duties and reshape the country's economic landscape, according to the World Bank South Asia Economic Update for April 2026. According to the report, the reform will reduce import duties by around 9 percentage points. It noted that Sri Lanka's average import duty currently stands at 19%, with a larger share coming from para-tariffs rather than standard statutory tariffs. These para-tariffs, including levies such as the Ports and Airports Development Levy and the Commodity Export Subsidy Scheme, are said to be phased out gradually under the government's national tariff policy by 2029. The World Bank indicated that this policy shift would have the strongest impact on the manufacturing sector. It explained that para-tariffs currently exceed statutory tariffs across all manufacturing industries. The largest reductions are expected in processed food and beverage sectors, while smaller changes are likely in areas such as textiles and mining. The report also highlighted labor market implications, noting that sectors affected by these changes employ nearly one-third of the workforce. It stated that overall benefits will depend on how easily workers can move between sectors. On the consumer side, household spending is projected to increase by about 3.1% in the short term. The World Bank noted that these gains are expected to be broad-based as the reforms apply across all import sources. Lower-income households, particularly in rural areas, are expected to benefit the most. This is due to their highest share of spending on food and manufactured goods. From a trade perspective, the report stated that the reform would shift incentives across export sectors. It noted that industries such as textiles and tea already operate under relatively low tariff structures, while sectors with high protection levels are likely to see the largest reductions. Import costs in some industries are expected to fall, which could improve competitiveness if supported by productivity gains. The World Bank also pointed out that Sri Lanka's approach differs from other countries as the tariff reduction are applied broadly across imports rather than being limited to specific trade agreements. This wider coverage is expected to generate stronger domestic price and welfare effects. Overall, the report concluded that the removal of para-tariffs would support economic activity by lowering costs, increasing consumption, and improving real incomes, particularly among lower-income groups. Sri Lanka's per capita gross domestic product has reached a historic milestone, crossing the $5,000 mark in 2025. According to data from the Central Bank of Sri Lanka, per capita GDP at current market price rose to $5,003 in 2025. This reflects a steady recovery over the past 3 years following the economic crisis. Per capita income increased from $3,464 in 2022 to $3,818 in 2023. It then rose to $4,546 in 2024 before reaching the latest record level in 2025. The data shows a clear reversal of the decline experienced between 2019 and 2022. During that period, per capita GDP fell from $4,080 in 2019 to $3,850 in 2020. It recovered slightly to $3,999 in 2021 before dropping sharply again in 2022 amid the economic crisis. The latest improvement reflects a recovery in economic activity along with the impact of exchange rate movement on dollar-based income levels. While the 2025 figure marks a nominal peak, it also highlights the extent of their earlier contraction and the pace of the subsequent rebound. Overall, the upward trend indicates improving economic conditions and a gradual restoration of income levels in the country. Sri Lanka's insurance sector has unveiled an ambitious new roadmap aimed at significantly expanding industry growth over the next decade. The Insurance Regulatory Commission of Sri Lanka has introduced a 7-pillar strategy designed to double insurance penetration by 2030 and triple it by 2035. According to the Insurance Industry Roadmap 2030 to 2035, the sector is targeting an annual growth rate of 14%. This is expected to push total premium income beyond 700 billion rupees by the end of the decade. Currently, the insurance market remains unpenetrated. Total premiums stood at 380 billion rupees in 2025, with penetration just above 1% of gross domestic product. Despite this, the sector plays a significant economic role. It manages assets exceeding 1.4 trillion rupees, supports more than 69,000 jobs and pays out around 172 billion rupees in annual claims. The Director General of the Insurance Regulatory Commission of Sri Lanka stated that low penetration levels should be viewed as an opportunity for growth. It was noted that the roadmap is expected to strengthen the country's financial foundation. The strategy has received strong government backing. The Minister of Public Security and Parliamentary Affairs expressed support for the initiative, noting that it aligns with the government's policy direction, particularly in digitalization. It also highlighted that a strong insurance sector can reduce the financial burden on the state during national disasters. The 7-pillar framework focuses on expanding coverage through affordable and standardized products, including proposals for mandatory home and motor insurance, as well as targeted health schemes. It also aims to modernize distribution channels by promoting digital onboarding, bank assurance reforms, and alternative platforms such as telecommunication networks and cooperatives. On the regulatory side, the roadmap proposes tax incentives for protection products and plans to strengthen the National Insurance Trust Fund to retain more risks within the country. The initiative is also expected to create over 17,000 new jobs and increase the sector's tax contribution to more than 108 billion rupees. Implementation will be overseen by a joint task force comprising the Finance Ministry, the Insurance Regulatory Commission, and industry stakeholders with regular performance monitoring. In parallel, new digital systems have been introduced to improve market discipline. The chairman of the Insurance Regulatory Commission of Sri Lanka announced the launch of centralized digital data system and a motor insurance digital card developed with the Credit Information Bureau and Mobitel. Overall, the roadmap signals a major transformation of Sri Lanka's insurance industry with a focus on growth, digital innovation, and stronger financial resilience. Sri Lanka's debt restructuring process is now nearing completion, with significant progress reported across both negotiations and implementation. According to the latest 6th Co-Chair's Progress Report released by the Global Sovereign Debt Roundtable, most key milestones have already been achieved. The report states that the signing of bilateral agreements with official creditors is well advanced, although not yet fully finalized. At the same time, only a small number of residual commercial creditors remain, with authorities continued good faith negotiations to conclude the process. Sri Lanka's restructuring is also noted as one of the major cases launched during 2021 and 2022 that has now been largely completed despite being carried out outside the G20 Common Framework. The report further highlights that Sri Lanka successfully completed the 4th review of its IMF-supported program in July 2025. In addition, the country received emergency financing under the IMF's Rapid Financing Instrument in December 2025, following the impact of a severe cyclone. Meanwhile, the World Bank extended up to $120 million in emergency support. This was done by repurposing funds from ongoing projects to assist recovery efforts and restore essential services and infrastructure. Overall, the report indicates that Sri Lanka's debt resolution process in its final stages, with only limited elements remaining before full completion. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 8.27%, up by 12 basis points. The 182-day T-bill rate stands at 8.23%, up by 1 basis points, and the 1-year T-bill rate stands at 8.52%, showing no change compared to the previous week. Thank you for watching. We'll be back next week.